So a week after talking about children's bedtime stories and market perspectives, this week we're going to dig a little bit deeper into what's moving your portfolio today. So we're going to touch on 4 big points today. Hopefully they'll give you some fodder for all those conversations you're happening around COVID and the election, and if it's coming up around your market, the portfolio, give you some ideas as well. Number 1 is just the macro events that are moving markets. 2, where are those important technical levels that people are watching? 3, quantitatively, how are things shaping up? And lastly, where are fundamentals sitting? So real quickly on macro, you heard about this all the time, but yes, it's the election. Yes, it's stimulus. We'll start with stimulus. Every day is a different story. The deal's off. It's got to happen by a certain day. It's back on. It's looking good. By the time this video comes out, you may have a deal. But everything we're reading, our own sense is that a deal is highly unlikely before the election. There's just not a lot of reason to get a deal done. There is a lot of reason to keep pretending like you're trying to get a deal done, but ultimately I think both parties are optimistic about the election and want to wait and see how that plays out and what kind of power they may have post November 3rd. With respect to the election itself, wanted to model out just a couple, whether you lean right or lean left, what to expect. With the Trump victory, the House probably stays blue. We think that leads to an initial market sell-off because the market will read into that less fiscal stimulus, or at least less fiscal stimulus quicker. By the same token, we think with tax rates likely to stay low in that type of scenario, regulations likely to stay low, the intermediate to long term would still look really good as far as markets are concerned. With the Biden victory, of course, it hinges on whether the Senate stays or flips. If there's a blue wave, which is what the market's starting to price in, what they're banking on there for those of you who are not voting for the blue wave and can't understand why that would be good markets, is a lot of fiscal stimulus. So yes, raising taxes is not something the market cheers. Yes, raising regulations is not something the market cheers. But a lot of money flooding the system is something that the market looks forward to, and it's betting that will be greater than whatever tax increases happen. And part of that is the likelihood that corporate taxes, which is again what the market cares the most about, are perhaps less likely to get raised in the midst of a still very weak economy. And on the personal side, that has less of an economic impact, less certainly of a market impact. And that's where the Democrats might be able to raise taxes, say they championed the cause that they are clearly running on, and at the same time not derail the economic engine. At the end of the day, we think either scenario still looks good for markets. And so whether, again, you lean right or lean left, take hope that your portfolio should be just fine after whatever initial aftershocks might come. From a technical perspective, we're stuck again in this important range. We think that's going to play out over the next 6 weeks. And again, not just because of the election, but for a whole host of reasons. The important levels to watch, if you're so interested, are 3250 to the downside on the S&P 500 and 3600 on the up. A break above or below either one of those opens up the doors to either 3000 below or 4000 above. I know that might scare some of you. Here's the good news. Everybody who is calling for that, even those who think 3,000 is the more likely path, still think the intermediate next 12 to 18 months look really, really good, and champion that as a great buying opportunity, and we would echo that sentiment. So again, something to emotionally prepare for. To the extent you need to prepare your portfolio, just be prepared to strike and take advantage of those opportunities should they arise. Quantitatively, just going to touch on a few things that, again, have us more cautious in the near term. 1, jobless claims are staying stubbornly high, about 25% above pre-COVID levels. Lots of research done that if you don't get this down quick enough, it becomes systemic. That would clearly be an economic headwind. Similarly, investment sentiment is still really high, but confidence in valuations is really low. That type of setup is usually one in which investor exuberance is manifesting itself. Again, not a great near-term entry point necessarily for risk capital. And lastly, watching risk-off assets versus risk-on. Utilities, treasuries, gold, things that usually mean you're entering into a risk-off period, remain stubbornly strong in the face of neutrality within equity markets. Lastly, fundamental. On the fundamental side of things, it really depends on who you're talking to. One camp will tell you, hey, it's way better than expectations. I guess that's true. On the other hand, some people will tell you, yeah, but those expectations were abysmally low, and that's also true. Earnings are down roughly 18% year over year, about 7% quarter over quarter. And so there's still a lot of work to be done. But companies, despite some tepid guidance, are articulating that they've got a path through this. And again, it's some of what leads to our longer term optimism around where the market and it's likely headed. In short, if you look at everything in total, a lot more catalysts, we think, setting up to the downside than the upside. But again, either can happen. It's more, again, about being emotionally prepared to take advantage and not be afraid of any type of market weakness. But longer term, with the monetary policy where it's at, likely fiscal stimulus, whether Biden or Trump gets elected, coupled with very low expectations year over year for companies to be able to beat. We still think for those of you who are in the market, things set up really, really well. With that, thank you for joining us. We'll see you soon.